Hello everyone, I'm John Analyst. Silver is trading under significant pressure right now, down sharply over the past several weeks, and the speed of this decline has caught many investors off guard. What we're witnessing is not a breakdown of the fundamental thesis we've been discussing, but rather a classic example of how short-term technical factors and positioning dynamics can overwhelm underlying fundamentals temporarily. Understanding exactly what's driving this pressure is critical because it determines whether this is a time to panic or a time to pay attention to opportunity. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. The current weakness in silver is creating one of the most interesting risk-reward setups we've seen in months, but only if you understand what's actually happening beneath the surface. Here on the Silver Reset, we cut through the noise and focus on the mechanics that actually move markets, not the headlines that generate clicks. Let me start with what's happened over the past few weeks to put this move in context. Silver peaked in mid-January around the $32 level, a price we hadn't seen sustained since early 2021. From that peak, we've seen a decline of approximately 15 to 18%, bringing prices back down to the $26 to $27 range. The decline has been relatively orderly initially, but has accelerated in the past week with some violent down days that triggered technical selling. Now let me walk you through the specific factors that are driving this pressure right now. First, and most importantly, the US dollar has strengthened significantly over the past month. The dollar index has rallied from around 103 to above 108, a move of nearly 5%. This represents one of the strongest dollar rallies we've seen in several months, and it's putting pressure on all dollar-denominated commodities, not just silver. The dollar strength is being driven by several converging factors. Economic data out of the United States has been surprisingly resilient, with employment numbers coming in stronger than expected, and consumer spending holding up better than many economists projected. This has forced markets to reassess the timeline for Federal Reserve rate cuts. A month ago, markets were pricing in 3 to 4 rate cuts starting as early as March. Now, those expectations have been pushed back, with the first cut potentially not coming until the second half of the year. Look closely at what this means for silver specifically. Silver, like all commodities, tends to move inversely to the dollar. When the dollar strengthens, it takes fewer dollars to buy the same amount of commodity, so prices tend to fall in dollar terms. Additionally, a stronger dollar reflects confidence in U.S. economic conditions and the Federal Reserve's policy trajectory, which reduces the appeal of alternative stores of value like precious metals. But here's where it becomes important to separate the signal from the noise. The dollar strength we're seeing is not driven by some fundamental improvement in U.S. fiscal conditions, or a reduction in debt levels, or a resolution of structural economic challenges. It's driven by relative performance versus other currencies, particularly the euro and the yen, which are facing their own significant headwinds. The dollar is the cleanest dirty shirt, rising not because of its own strength, but because of weakness elsewhere. Now notice the second major factor putting pressure on silver right now. Real interest rates have ticked higher over the past month. The 10-year Treasury yield has moved from around 4.2% to 4.5%. While inflation expectations have remained relatively stable, this means real yields, nominal yields minus expected inflation, have increased by roughly 30 basis points. Higher real yields increase the opportunity cost of holding non-yielding assets like silver. If you can earn a positive real return in Treasury bonds, the relative attractiveness of silver diminishes. Investors who were positioned in precious metals as a hedge against negative real rates are reconsidering those positions as real yields move into positive territory. Let me explain why this matters in the current context. The move higher in yields is not being driven by Fed policy changes, since the Fed hasn't actually raised rates. It's being driven by market repricing of rate cut expectations and by heavy Treasury issuance as the government continues to run large fiscal deficits. The Treasury is flooding the market with new supply at a time when some foreign buyers, particularly China and Japan, have reduced their purchases. This creates upward pressure on yields, which in turn creates downward pressure on precious metals. But this dynamic is inherently unstable. If yields continue to rise significantly, it will create financial stress in other parts of the economy. Corporate debt service costs will increase, mortgage rates will rise, stock valuations will face pressure from higher discount rates. At some point, rising yields become deflationary and contractionary, which would force the Fed to reverse course and cut rates aggressively. Look at what's happening with the technical picture in silver, because this is amplifying the fundamental pressures. Silver broke below key technical support at the $29 level about 10 days ago. That breakdown triggered stop-loss orders and algorithmic selling, which accelerated the decline. Once the selling began, momentum traders and systematic funds that follow trend-following strategies started reducing long positions, or even establishing short positions. The futures market positioning data shows a significant reduction in speculative long positions over the past 2 weeks. Hedge funds and large speculators who were heavily long silver near the highs have been liquidating those positions. This is classic momentum-driven selling where the price action itself becomes the catalyst for further selling, regardless of fundamentals. Now, let me walk you through what's happening in the physical market, because this tells a very different story than the paper market. Despite the sharp decline in spot prices, premiums on physical silver products have actually increased. Dealers are reporting strong buying interest from retail investors who view the pullback as an opportunity. American Silver Eagles are trading at premiums of $5 to $7 over spot in many markets. Generic rounds and bars are showing premiums of $3 to $4. This divergence between paper and physical markets is significant. It tells us that the selling pressure is concentrated in futures and derivatives markets, not in the physical market where actual metal changes hands. Retail investors are buying. Industrial users are not reducing their consumption because prices fell 15%. The selling is coming from leveraged speculators and systematic funds in the paper market. But here's where the positioning dynamics become critical to understand. When speculative positioning becomes extremely one-sided, either heavily long or heavily short, the market becomes vulnerable to sharp reversals. In mid-January, when silver was trading at $32, speculative positioning was near multi-year highs. Too many people were leaning the same direction. That creates a crowded trade that's vulnerable to any catalyst that triggers selling. The dollar rally and the repricing of rate cut expectations provided that catalyst. The initial selling triggered stop losses, which triggered more selling, which triggered algorithmic momentum systems, which created a self-reinforcing downward spiral. This is how markets work. Price drives positioning, which drives more price action until the move exhausts itself and reverses. Look closely at what typically happens after these liquidation events. Once the weak hands and the momentum traders have been flushed out, once positioning has reset to more neutral levels, the market becomes vulnerable to a reversal. If the fundamental drivers that took silver to $32 in the first place remain intact, and I would argue they do, then the current weakness represents a reset of positioning rather than a breakdown of the bull case. Now notice what hasn't changed despite the recent price action. Industrial demand for silver continues to grow. Solar installations are still expanding globally. EV production is still ramping. AI data center construction is still accelerating. None of these demand drivers have reversed because silver fell from $32 to $27. The demand is structural and price inelastic. Supply remains constrained. Mine production is still flat to modestly declining. New mine development is still facing long lead times and regulatory hurdles. Recycling rates haven't suddenly surged. The structural supply deficit that we've discussed in previous videos hasn't disappeared. It's still there, still drawing down inventories, still creating the conditions for future supply stress. Let me explain what's happening with the macroeconomic narrative, because this is influencing investor psychology. The dominant narrative in markets right now is that the US economy is more resilient than expected, that a recession has been avoided, and that the Fed can maintain higher rates for longer without breaking anything. This narrative supports the dollar, supports yields, and pressures alternative assets like precious metals. But this narrative is vulnerable to reversal. The lag effects of higher interest rates take time to work through the economy. Commercial real estate is under significant stress. Regional banks are still dealing with underwater bond portfolios. Consumer credit card debt and delinquencies are rising. Auto loan defaults are increasing. These are not the characteristics of a healthy, resilient economy. These are signs of stress building beneath the surface. If economic data starts to weaken in coming months, and I would argue the probability of that is high, given the level of rates and the accumulated debt in the system, the narrative will flip quickly. Markets will go from pricing no rate cuts to pricing emergency cuts. The dollar will reverse, yields will fall, and precious metals will rally sharply as investors rush back to safe haven assets. Look at the seasonal patterns in silver because these provide additional context. February and March are historically weak months for precious metals. Tax selling, year-end portfolio rebalancing, and seasonal factors often create downward pressure in the first quarter. We saw similar weakness in February of 2023 and February of 2024. Silver declined roughly 10 to 15% in both instances before recovering later in the year. This doesn't mean the current decline is guaranteed to reverse on a specific timeline, but it does suggest that seasonal headwinds may be contributing to the pressure, and those headwinds typically abate as we move into the second quarter. Investors who understand these patterns can use seasonal weakness to accumulate positions at better prices rather than panicking into selling. Now let me walk you through what the options market is telling us about sentiment and positioning. Put-call ratios in silver options have spiked higher, indicating that traders are buying downside protection or speculating on further declines. This is a contrarian indicator. When everyone is positioned for more downside, when bearish sentiment becomes extreme, that's often when the market is close to a bottom. Volatility has increased significantly, which is typical during sharp declines. Higher volatility creates uncertainty and discomfort for investors who aren't accustomed to precious metals price swings. But for those who understand that volatility is a feature of silver, not a bug, elevated volatility creates opportunities. Option strategies that benefit from volatility can be deployed. Physical accumulation becomes more attractive when volatility shakes out weak hands. But here's where investor psychology becomes the dominant factor. Most retail investors who bought silver near the $32 level are now sitting on losses of 15 to 20%. Human nature is to panic when positions move against you, especially when the decline happens quickly. The emotional response is to sell to make the pain stop, to preserve what capital remains, to avoid further losses. This is exactly the wrong response. Selling after a 15% decline locks in the loss and removes you from the position right when the risk-reward is improving. The time to sell was at $32 when everyone was euphoric and positioning was overcrowded. The time to buy is now when everyone is fearful and positioning has reset. But doing this requires discipline and conviction that most investors simply don't have. Look closely at the institutional investor behavior because this reveals where the smart money is positioned. Large asset managers who allocate to precious metals as a strategic portfolio holding don't panic sell on 15% declines. They rebalance. If their target allocation is 5% to precious metals and prices have fallen, they buy more to bring the allocation back to target. This disciplined rebalancing into weakness is how institutions outperform retail investors over time. Now notice what's happening with mining stocks, because these often provide signals about where the metal price is headed. Silver mining stocks have declined more than the metal itself, which is typical given their leverage to the underlying commodity. But we're starting to see divergences where some of the higher quality producers are holding up better than the metal or showing relative strength during down days. This suggests that smart money in the equity markets may be accumulating mining shares at these levels, anticipating that the metal price will recover. Mining stocks often bottom before the metal itself because equity investors are forward-looking and position ahead of the turn. If we start to see consistent positive divergences where mining stocks rally while silver is still weak, that would be a strong signal that a bottom is forming. Let me explain what's happening with ETF flows, because this data provides insight into investment demand trends. Silver ETFs have seen modest outflows over the past few weeks, as some investors have liquidated positions in response to the price decline, but the outflows have not been dramatic or panic-driven. Holdings in the major silver ETFs are down roughly 2 to 3% from their recent peaks, which is relatively minor. This suggests that most ETF holders are maintaining their positions despite the weakness. They're not panic selling. They're either holding through the volatility or, in some cases, adding to positions at lower prices. If we were seeing massive ETF outflows of 10 or 20%, that would signal genuine capitulation and loss of confidence in the silver thesis. We're not seeing that. But here's where the current situation creates opportunity for those who understand market cycles. Silver is a cyclical asset that moves in waves. It rallies, it corrects, it consolidates, then it rallies again. The investors who make money in silver are the ones who accumulate during the corrections and consolidations, then hold through the rallies. The investors who lose money are the ones who buy the rallies and panic sell the corrections. Right now, we're in a correction phase. The rally from $22 to $32 attracted momentum traders, retail enthusiasm, and overcrowded positioning. The correction is flushing out that excess, resetting positioning, and creating the conditions for the next leg higher. How long the correction lasts and how low it goes is unknowable, but the pattern is predictable. Look at the fundamental factors that drove silver to $32. Have they reversed? Is industrial demand collapsing? No, it continues to grow. Has mine supply suddenly surged? No, production remains constrained. Have the macroeconomic conditions that favor real assets over financial assets changed structurally? No. Debt levels are still rising, deficits are still massive, and currency debasement concerns remain valid. What's changed is short-term positioning, technical factors, and sentiment. These are the variables that create volatility and opportunity. They're not the variables that determine the long-term trajectory of the market. The long-term trajectory is determined by physical supply and demand fundamentals, and those fundamentals remain supportive of significantly higher prices over time. Now let me walk you through what a rational response to the current situation looks like. First, assess your position sizing and risk tolerance. If you're overallocated to silver, such that the decline is causing you genuine financial stress or emotional distress, then your position size was too large to begin with. The solution is not to panic sell, but to recognize that you need to manage position sizing more carefully in the future. Second, separate your time horizon from short-term price action. If you allocated to silver as a strategic holding with a multi-year time horizon because you believe in the structural supply deficit thesis and the macroeconomic case for real assets, then a 15% correction over a few weeks is noise. It doesn't change the thesis. If anything, it validates the thesis because it demonstrates the volatility that creates opportunity. Third, consider whether the current price level offers an opportunity to add to positions or establish new positions at better prices than were available a month ago. This requires having dry powder, cash on the sidelines, specifically allocated for buying during corrections. If you were fully invested at $32, you have no ability to take advantage of $27. Capital preservation and patient positioning matter. Look closely at what the gold-silver ratio is doing because this provides relative value context. The ratio has moved from around 75 when silver was at $32 to above 80 now. This means silver has underperformed gold during the correction, which is typical because silver is more volatile, but it also means that silver is now cheaper relative to gold than it was a month ago. If you believe in mean reversion in the gold-silver ratio, and history suggests you should, then current levels represent better value in silver relative to gold. Investors who allocate between the two metals can shift allocation towards silver at these levels, recognizing that when the ratio compresses back towards 70 or 65, silver will outperform substantially. But here's what's critical to understand about the current geopolitical backdrop. While silver has been declining, geopolitical tensions have not dissipated. Trade disputes continue. Military conflicts persist. The structural competition between great powers over technology, resources, and economic influence is intensifying. These tensions support the case for holding real assets that aren't subject to counterparty risk or political manipulation. The decline in silver prices, despite ongoing geopolitical uncertainty, is actually unusual and suggests that positioning and technical factors are overwhelming the fundamental bid from safe haven demand. This creates a dislocation that historically resolves with sharp reversals higher once the technical selling exhausts itself. Now notice what's happening with physical demand from different regions globally. Asian buyers, particularly in India and China, have been aggressive buyers of physical gold and silver during this decline. Eastern investors tend to have a different mentality than Western investors. They view precious metals as generational wealth preservation, not as trading vehicles. Price declines are buying opportunities, not reasons to panic. This East-West dynamic creates a floor under precious metals prices. Western speculators may sell futures and drive paper prices lower, but Eastern physical buyers absorb that metal at cheaper prices and remove it from the market. Over time, this drains physical supply and sets up the conditions for supply squeezes when Western investors eventually want to reaccumulate positions. Let me explain what to watch for as signals that the correction is exhausting and a bottom is forming. First, watch for a deceleration in the rate of decline. If silver was falling 2 or 3% per day, and that slows to 1% or stabilizes, that's a sign that selling pressure is diminishing. Second, watch for increasing volume on down days followed by decreasing volume. This suggests that sellers are becoming exhausted. Third, watch for positive divergences in technical indicators. If the RSI or other momentum indicators start to turn higher while price is still making marginal new lows, that's a bullish divergence that often precedes reversals. Fourth, watch for changes in the dollar and yields. If the dollar rally stalls or reverses, if yields start to decline, those are the macro catalysts that could trigger a sharp reversal in precious metals. Fifth, watch for changes in the narrative. If economic data starts to disappoint, if recession fears return, if the Fed signals concern about financial stability, the market narrative will shift quickly from higher for longer to emergency cuts. That shift will benefit precious metals dramatically. Look at the historical context for how corrections within bull markets typically unfold. During the 2000 to 2011 silver bull market, there were multiple corrections of 20 to 30% that terrified investors and convinced many that the bull market was over. Every single one of those corrections resolved higher, and investors who sold during the corrections missed the bulk of the gains. The correction in late 2004 saw silver fall from $8 to $6, a 25% decline. Investors who sold in panic missed the subsequent rally to $14. The correction in 2008 saw silver fall from $21 to $9, a 57% decline. Investors who sold missed the rally to $49 over the next 3 years. The current correction from $32 to $27 is roughly 15%. In the context of silver's historical volatility, this is a normal and healthy correction within an ongoing bull market. It's painful for those who bought at the top, but it's creating opportunity for those with capital and conviction. But here's where discipline separates successful investors from unsuccessful ones. Successful investors have a plan. They know what they own and why they own it. They have position sizing rules. They have price levels where they'll add to positions. They have time horizons that extend beyond weeks or months. They don't make emotional decisions based on short-term price action. Unsuccessful investors chase performance, buy near tops because of FOMO, panic sell during corrections, and repeat the cycle. They allow emotions to override analysis. They confuse volatility with risk. They don't have a plan, so they react to whatever the market does, rather than acting according to a predetermined strategy. The current environment is testing which type of investor you are. If you're panicking, if you're considering selling because the decline is uncomfortable, you need to reassess whether you should be invested in volatile assets at all. If you're calmly analyzing the situation, recognizing this as a normal correction and considering whether to add to positions, you're thinking like a successful long-term investor. Now let me walk you through what happens if the correction extends further. What if silver falls to $25 or even $23? Would that invalidate the bullish thesis? Not necessarily. It would simply mean that the correction was deeper than expected, which happens in volatile markets. The fundamental supply-demand dynamics would remain intact. Industrial demand wouldn't disappear. Supply constraints wouldn't resolve. Deeper corrections create better entry points for those who missed earlier opportunities or who want to add to positions. They also create more extreme sentiment readings, with fear and capitulation reaching levels that historically mark major bottoms. The worst time to sell is when everyone else is selling and sentiment is at its most bearish. Look closely at what central banks are doing with gold purchases, because this provides context for precious metals broadly. Central banks globally continue to be net buyers of gold, adding to reserves as a hedge against dollar dominance and currency instability. While central banks don't buy silver, their gold buying validates the thesis that monetary authorities are concerned about fiat currency stability and are diversifying into hard assets. If central banks are buying gold as insurance against monetary instability, individual investors should be considering similar allocations. Silver offers similar monetary properties to gold, but with additional industrial demand drivers and at a more accessible price point. The logic that drives central bank gold buying applies equally to individual silver allocations. But here's the reality that most investors don't want to hear. Nobody can tell you with certainty that silver has bottomed at $27. It might fall further before it recovers. Market timing is extremely difficult, and trying to pick exact bottoms usually results in either missing the entry entirely or catching a falling knife and experiencing more short-term pain. The better approach is to think in terms of ranges and probabilities. Silver in the mid to upper 20s offers substantially better risk-reward than silver at $32. If you're going to allocate to silver as a strategic position, doing so at current levels makes more sense than doing so at recent highs. You might be early, you might experience more short-term drawdown, but you're positioning at better prices with better long-term potential. Here on the Silver Reset, we focus on understanding market mechanics and making rational decisions based on evidence and logic rather than emotion and hype. The current weakness in silver is driven by technical factors, positioning dynamics, and short-term macro headwinds. These are the factors that create volatility and opportunity. They're not the factors that determine long-term value. Thanks for watching. Subscribe to the Silver Reset right now. Share this with anyone who's trying to make sense of the current price action and needs a rational framework for thinking about corrections versus breakdowns. Comment below with how you're responding to the current environment and what signals you're watching. Stay alert, because what's happening in the silver market right now matters more than most people realize. Corrections are painful but necessary. They reset positioning, flush out weak hands, and create opportunities for those who understand the difference between price and value. The investors who profit from silver are the ones who buy when it's uncomfortable, not when it's exciting.